you learned about current liabilities. This week we are going to focus on long-term liabilities. Now, remember, normally 1 year is kind of the mark that we use to make the distinction between current liabilities and long-term liabilities. Generally speaking, current liabilities are those that will be paid within 1 year or less, and long-term liabilities are those that will be paid in more than 1 year. Some of the most common examples are going to be bonds payable, long-term notes payable, and mortgages payable. Okay, so let's look at an example here of a long-term notes payable. On December 31st, Smart Touch Learning signs a $20,000 note payable. It's due in 4 annual payments of $5,000 plus 6% interest each December 31st. So we record this with a debit to cash and a credit to notes payable for the $20,000. All right, now, you'll recall with notes, the one thing that distinguishes a note from a regular account payable is the interest that's involved. A note payable is always going to have some sort of interest involved. So this week we are going to learn how to put together amortization schedules, which allow us to compute the amount of interest that should be allocated to each period. Okay. Now here we see a note payable amortization schedule, and you can see how they compute the interest expense each period. They then determine the amount that goes toward the principal. That's just going to be the difference between the total payment and the interest expense. And then the ending balance of the note is always going to be the beginning balance of the note less the principal payment. Remember, interest is an expense to the company, but it doesn't actually reduce their obligation with regards to the note. All right, so here we see an example of what a payment would look like. All right, so when they make that payment of $6,200, they're only going to debit notes payable for $5,000. That's the amount that's actually reducing the payable. That's the portion going towards principal. That $1,200 interest expense is just going to be debited to the expense account. Okay, mortgages payable are very, very similar. The main thing that distinguishes a mortgage payable from a notes payable, mortgage payables are generally always going to be secured with specific assets. Normally it is going to be that specific property. For example, if you have a personal mortgage on your home, that liability is secured with your home. Your home is the collateral. If you, don't make the payments to the bank, they can then basically repossess that asset, whatever that asset is, whether it's your home or for it's a company, it might be a building or a factory or whatever the case may be. Okay, so here's an example. On December 31st, Smart Touch Learning purchases a building for $150,000. They pay $49,925 in cash, and they sign a 30-year mortgage for that difference of $100,075. It's going to be an annual interest rate of 6%, payable in $600 monthly payments, which includes both principal and interest. So the first entry that we're going to make is a debit to the building. We're going to credit cash for the amount of cash that we paid, and the rest is going into that mortgage payable account. Okay, and here we see the amortization schedule for the mortgage payable. Now, they show you how these calculations are made in terms of how we can compute the interest expense, how we can compute the principal portion, and how we can compute that ending balance. And you can actually build your own Excel spreadsheet by entering these formulas in. But one thing that I want to mention too is Excel has a great built-in feature that will automatically build an amortization table for you. And essentially all you have to do, you have to put in the amount of the mortgage, you have to put in the annual interest rate, when it starts, and how many payments are going to be made per year. And at that point, Excel will actually build an amortization table for you, which is really, really cool. If you have a mortgage, I would recommend doing that with your own mortgage if you haven't already. It's a neat thing to do. And it's a great way to keep track of, not only where you are in terms of principal and interest payments, but the built-in charts in Excel will also allow you to measure how your interest and expense, or your interest and your principal payment, will change if you pay extra on your mortgage. So that's something neat to see as well. So that's just something I thought I would throw out there. But if you would rather just build your own chart in Excel, you can certainly do that. You'll just use the exact formulas that they have listed here in order to compute the balances. Okay, so based on that amortization table, we know the portion of our payment that's going to go to principal, which is the mortgage payable. We know the portion that's going to go to interest, and we know that cash is just going to be the amount that we paid. And for a long-term note like a mortgage payable, this is actually pretty common. This is what you see on the early end of the mortgage. A huge chunk of your payment goes towards interest. That's why it takes so long to pay off a mortgage. It is because in those early years, the vast majority of your payment is going to interest. The same is true for businesses. Now we're going to talk about bonds. This is the primary way that large companies will raise large amounts of money. Okay? It's when we're thinking about taking out loans and that sort of thing, even a big company might have a hard time finding somebody that's willing to loan them $500 million or $1 billion or something like that. It's going to be very difficult to find a bank to do that, even if you're a big company. Okay, even if you're Amazon or you're Walmart, it's going to be difficult to find somebody willing to lend you huge amounts of money. So what bonds payable allow a company to do is essentially break this huge debt into small increments, normally it's $1,000, into small $1,000 increments. And then they can issue them to different people, and they don't have to get all of the money from one lender. So that's essentially the function of bonds payable. It's a way to raise huge amounts of capital from lots of different investors rather than just getting it from, say one bank. Okay, so we're going to look at how we account for bonds payable. Okay, now before we get in too deep, we've got to recognize some basic terms associated with bonds payable. And I'm going to go back to the previous slide for just a second because I do want to grab this. Face value is simply the amount of the bond. It is the amount that the borrower has to pay back on the maturity date. It's always the stated amount of the bond. So if it's a $1,000 bond, face value is $1,000, okay? Excuse me. The stated interest rate is always going to be the amount stated on the bond. Sometimes you will see this called the face rate or the coupon rate, all right? That is the rate at which the interest will actually be paid to the investor or the bondholder. Okay, for example, just as an easy example, if somebody buys a $1,000 bond and it has a 5% annual interest rate, the amount of interest that they receive every year is going to be that $1,000 times 5%. So that's the significance of the stated interest rate. It is how we determine the amount of interest that the company is actually going to have to pay to those bondholders. All right, so let's look at an example. All right, a 5-year 9% bond issued at face value of $100,000 is going to pay 10 semi-annual interest payments of $4,500, and that's just the $100,000 face value of the bonds times the 9% interest rate, and they multiplied by 6 over 12 because it's going to be paid twice a year. So we're not paying 9% twice a year, we're paying 4.5% twice a year for an annual rate of 9%. And so here we see exactly what those cash flows are going to look like. So the company gets the $100,000 when they issue the bonds. They are going to pay that $4,500 every 6 months over the life of the bond. And then at the end of the bond, they are going to repay that $100,000 to those bond holders. Okay. Now let's talk about bond prices. Now, we talked about the face value of the bond being the $1,000. However, the bond is not always issued at that face value. It could be issued at a discount or a premium. It's pretty common for bonds to be issued at a discount. Now, this will be based upon how the bond's stated interest rate compares to the current market rate for investments of similar risk at the same period of time. Okay? Essentially, if a bond's stated interest rate is the same thing as the market rate for a similar investment, then it'll be issued at face value. Okay? If the bond's stated rate is less than what the market is paying, the bond will be issued at a discount. If the bond's stated interest rate is more than what the market rate is for a similar investment, then the bond will be issued at a premium. That is more than the face amount. Now, we're going to learn in just a little bit how to actually make the calculation. But first, let's talk just real quickly about the basic theory here. Let's focus on a discount because the same basic theory is going to apply to premium, okay? But let's focus on discount first. All right, if a bond's stated interest rate is paying less than what the market rate for a similar investment is going to be, then in theory, why would an investor want to buy that bond, right? If they could buy a similar bond and get a higher rate of interest, why in the world would they want to buy that bond, right? So that's kind of the basic premise here. An investor is only going to invest in something if they can get an appropriate return based on market rates. So what happens is if the company's bonds are only going to pay 9% and the market interest rate is 10%, well, what happens is the company issues the bonds at a discount, meaning the investor doesn't buy it for $1,000. They might buy it for $950 or $960 or whatever the case may be. They're going to pay less for it. And what's going to happen based on the amount that they pay for it, they will earn an effective interest rate that is equal to the market rate. Now, again, there are some complex calculations behind that, and we're gonna look at those in just a few minutes, but that way you understand the basic theory behind issuing at a discount or a premium. Now, let's talk about why a company might decide to issue bonds versus issuing stock. We know that really a company has two basic options when it comes to financing their business. They can either finance through debt or finance through equity, okay? Debt primarily being bonds, equity primarily being stock. There are advantages and disadvantages to both. However, one of the primary advantages associated with issuing bonds is that generally speaking, interest expense is tax deductible. Dividend payments to shareholders are not tax deductible because they're not considered an expense. They're considered a distribution of earnings rather than an expense. So that is one of the reasons that a company will sometimes decide to issue bonds. Also, if management believes that they can earn a greater return through operations compared with the amount of interest they're paying on those bonds, then it may be worth it to have that debt. If they can basically earn a return that is greater than what they are paying, then it may be worth it to them. All right. So one measure that we may use to evaluate a company's solvency and especially evaluate their relationship between debt and equity is the debt to equity ratio. And it just essentially compares how a company is financing their total assets. It looks at the relationship between total debt to total equity. All right. If a company has a ratio that's higher than 1, then that indicates that they're using more debt than they're using equity, and vice versa is true. If the number is less than 1, then that indicates they're using more equity and less debt. Okay. Here we see an analysis of Kohl's Corporation. And we'll look at the computations on the following slide, but we can easily look here and see that the company is using more debt than they are using equity. The liabilities are higher than their equity. If we make the calculations for 2015 and 2014, we see that their debt to equity ratio is actually 1.48 in 2015 and 1.39 for 2014. Next, we're going to talk a little bit about the time value of money. And this is where we get into those complex calculations. And I say complex, they're really not too bad. I don't want you to be afraid. Once you learn this process, it's pretty simple to apply. And we're going to look through some examples together. And I have an example for you in the instructor guidance as well. And so don't worry about a thing. You're going to be just fine on this, okay? So the time value of money is basically the principle that $1 today is worth more than $1 in the future. $1 today could be invested and it could grow. Okay, so money in the future is worth less, money today is worth more. That's the basic concept of the time value of money. We're going to see how that principle can apply to bond valuations. Okay, so some things that we need to keep in mind. Okay. The principal amount, that's just your amount. Okay, so that's going to vary, and again, it'll make more sense when we look at some examples, but that's the amount that you're focusing on. The number of periods, this is something really important to remember when we're using the time value of money. The number of periods always refers to the number of interest periods. That may or may not be the same thing as the number of years. So for instance, if I said that we were talking about a 5-year bond with semi-annual interest payments, your number of periods would not be 5, it would be 10. Because while the bonds are 5-year bonds, if interest is going to be paid twice per year, then you have a total of 10 interest periods. So the number of periods always represents the number of interest periods. That's something very important to remember. And similarly, your interest rate is always going to be represented based on the number of periods. So you have to adjust your interest rate to match your interest period. Okay, let's kind of stick with the same example. Let's say that I've got 5-year bonds that are going to pay interest semi-annually. So they're paying interest twice per year. Let's say that the annual rate on the bonds is 12%. Well, if the annual rate is 12%, then the semi-annual rate would be 6%, which is half of that. So if we were going to use the time value of money to make calculations, we would have 10 interest periods at 6% rather than 5 periods at 12%. So I hope that makes sense. And again, as you work through some examples, I think it's going to be much easier to see, but just so you kind of have a grasp on the basic theory and principles here. All right, now in your book, you're going to learn about simple interest versus compound interest. I'm not going to focus too much on simple interest because you're rarely going to see simple interest used. Compound interest applies on essentially everything. Compound interest simply means that interest is always computed on the ending balance. So if it's an investment, for example, let's say that we're talking about an investment. You invest a certain amount of money today, and over the course of the month, it gains interest. Well, at the end of the month, you're not only going to, earn your normal rate of interest, whatever that is, but you're going to earn interest on the interest from previous periods as well. Basically, your kind of think of a snowball. Your balance just keeps snowballing. But and I'm using that example as an investment, but the thing is, the same thing happens with debt too, okay? If anyone's ever had a credit card, you understand exactly what I'm talking about there. Your interest accrues every period, and if you don't pay it down, you will eventually be paying interest on your interest, because you will always be paying interest based on your ending balance. So again, compound interest is just, the vast majority of the time it's what we use in the world. I'm not saying you'll never encounter simple interest. You very well may, but compound interest is certainly the one that you are going to see most frequently. Now, when we're making these calculations using the time value of money, we're primarily going to be looking at present value factors. There are many uses for future value as well. Most of the time when you're studying bonds, you're primarily going to be using present value factors. I can tell you that you can actually use Excel to compute present value, but honestly, I think it's just as easy to use the tables. I'm kind of old school. That's how I learned, and I kind of like to use the tables. The primary ones that you are going to use for bonds payable calculations are going to be this table here, A1 and A2. That's the present value of $1 and then the present value of an ordinary annuity. We'll use the present value of 1 to compute the present value of the bond repayment. That is at the end of the bond period. And then we will use the annuity calculation to compute the present value of the interest that the bondholders would receive. Okay, so let's just kind of look at the basic calculation of how we compute the present value of a lump sum. Okay, so if we want to know, how much we would need to invest today to have $13,383 in 5 years, if the interest rate is 6%, then we can use the present value factor table in the table A1 to make this calculation. And again, this time they tell us 5 years, and in this case, there's no semi-annual interest payment, so we can use 5 is our N, and we can use 6% as our I. And what you'll find with these tables is the tables are going to have the interest rates going across the top in the columns. They are going to have the number of periods going down the left-hand side, so essentially the rows. And what you're going to do is you're going to find the N figure that you need, and you're going to find the interest figure that you need, and then you are going to see where those points intersect on the chart, and that is going to give you your factor to use. In this case, our factor is 0.747. You should be able to look at the table and find that, and that's where we can compute present value. So we could just take the amount times that present value factor, and we get present value. So that's just kind of an example of how we can use those charts for our calculations. Now let's look at how we'll do the same thing with an annuity, okay? Now the only thing different between a lump sum and an annuity just means that we are going to be receiving a series of payments. It's not just a one-time thing. It means that we are going to be receiving that amount over and over multiple times. That's what makes it an annuity, okay? So this time they say we're going to receive $2,000 at the end of each year, and that we're still assuming the 5 years and the 6%. So now we want to know what the present value is. Well, this time our amount is the $2,000, and we find the present value factor of an annuity. Now this time we have to use the annuity table, but it's still the same approach. You're going to go down to the row where N equals 5, you're going to scoot over to the column where I is equal to 6%, and you should find this factor of 4.212. We multiply that by our amount, and that gives us the present value of the annuity. Okay, so now we're going to look at how we apply these concepts to compute the present value of a bond. And that's essentially how we're going to determine how much we can issue a bond for. Investors are only going to be willing to pay present value. So that's based on the market rate, what similar investments are paying. Okay, so we have two pieces that we have to calculate. We've got to determine what is the present value of that eventual payment they're going to get. So if I'm a bondholder, excuse me, and I'm purchasing a $1,000 bond, at some point in the future, I'm going to get that $1,000 back. So I want to know what's the value of that $1,000 that I'm going to receive in the future, the present value, and what is the present value of those series of interest payments that I'm going to receive between now and then. Okay, so we are going to assume that Smart Touch Learning issues $100,000 of 5-year 9% bonds that pay interest semi-annually. The market interest rate is 10%. So when we see a stated rate that is less than the market rate, that is a red flag that we are looking at a discount, okay? Because people are not going to pay full price for these bonds because they pay less in interest than similar investments based on the market rate, okay? So we know we're going to be looking at a discount, but we got to figure out how much. How much is this discount going to be, okay? So our maturity amount is going to be the $100,000. That's what the company's going to have to repay the bondholders when these bonds mature. Periodic interest is going to be $4,500. That is simply the $100,000 times the 9% stated rate times half a year, okay, because it pays semi-annually. So the interest rate, the market interest rate, is 10% or 5% semi-annually. The number of periods are 10 because we have payments twice a year for 5 years. Now, one thing that I want to emphasize here is when we are computing present value for interest rate, we always use the market rate, not the stated rate. The stated rate is used to calculate the interest payment. But when we are calculating present value, the interest rate that we use is the market rate, not the stated rate. Okay, so in this case, it's the 10% or 5% semi-annually. Okay, and again, we use our present value chart. So in this case, we're going to look at the present value factors for a single sum for the $100,000. We're going to go down to 10 interest periods, move across to an interest rate of 5%, and you should find a present value factor of 0.614. So 100,000 times 0.614, present value of the $100,000 today is $61,400. Now, we want to know what is the present value of those interest payments, okay? So in this case, we need to pull up the present value of an annuity table. Now, in this case, they're showing the $100,000 times 9% times 6/12. And that is correct. That's how we computed the interest payment, but we already saw the interest payment on the previous slide. It is $4,500. If you take $100,000 times the 9% stated rate times half a year, you will get $4,500. So the $4,500 interest payment times 7.722, and that is simply the annuity factor that you should find on that table if you scroll down to period 10 and then move over to the column that has the interest rate of 5%. That intersection point should be a factor of 7.722. That means the present value of that series of interest payments is $34,749. Total present value of the bonds is going to be the present value of the principal plus the present value of all of those interest payments. In this case, it is $96,149. So what that tells us is when we issue these $100,000 in bonds, those bondholders are not going to pay us $100,000 because these bonds aren't worth $100,000. These bonds are worth $96,149. Now, what's also important is when we issue these bonds at $96,149, but we pay the bondholders that $4,500 interest payment for the next 10 interest periods, they will effectively be earning a rate of 10% on these bonds. And that's why they're willing to pay the $96,149. So I think it's important to emphasize that relationship between the present value of the bonds and the market rate. The present value essentially tells you what you can sell it for in order to yield that market rate for investors, which is what they are willing to pay. All right, so now we're going to look at the opposite, okay? This time they're going to issue the bonds at a premium. All right, so Smart Touch Learning, just a second here. My apologies, guys. This slide had a typo on it, but I fixed it now so we can move forward. We're going to look at the present value of bonds payable when they're issued at a premium, okay? So this time we're assuming that we're still issuing that same $100,000 of 5-year bonds with a stated rate of 9% interest paid semi-annually. Okay, so it's basically the same bonds, but this time we're assuming that market conditions are a little bit different. This time, instead of the market interest rate being 10%, this time the market interest rate is 8%. Okay, that means our bonds are actually paying more than the market. So what that means is investors are going to be willing to pay more for our bonds for that reason, because they're getting a higher return than what the market's currently paying. So let's look at our key elements that we're going to need to make the present value calculation. Maturity payment is exactly the same. Okay, it's the face value of the bonds. Periodic interest, exactly the same. Again, periodic interest is always based on the stated rate of the bonds times the face value of the bonds. So in this case, it's the 100,000 times 9% times half a year, okay, for $4,500. Interest rate, remember, we always use the market rate as our interest rate. When we're doing our present value calculations, you're always looking for that market rate. The stated rate determines the interest payment, but it's the market rate that determines our present value calculations. So in this case, it's 8%, but because it's paid semi-annually, it's going to be 4%. Number of periods, it is going to be 10 interest periods because we are paying payments twice a year for 5 years. And our calculations are going to essentially look exactly the same as they did with the discount problem that we just worked, okay? We're going to use that same present value factor of a lump sum table, but this time we're going down 10 interest periods, but we're only going over to the 4% column. Remember last time we used the 5%. So this time we're only going over to the 4% column. That gives us a factor of 0.676. So our present value of principal is $67,600. Now we figure out the present value of those interest payments. Again, now we're going to move to the annuity table. We're going down to interest period 10. We're going to scoot over to the column for 4%. That intersection point, you should find the annuity present value factor of 8.111. We multiply that by the annuity amount of $4,500, and we get $36,500. When we add together the present value of the principal and the present value of the stated interest, we get $104,100. So we get a little bit more than the face value of the bonds. What this tells us is these bondholders are willing to pay a little bit more for these bonds because they are going to be getting a higher interest payment compared with what the current market rate is. And similar to the discount, What this is telling us, when we sell these bonds for $104,100, as these bondholders receive that interest over the period and they're only paid back the $100,000 in the end, what happens is they have effectively earned a return of 8% rather than the stated 9%. So that's the whole basis of our present value calculations. The investors are always going to be earning the market rate. And it's that market rate that's going to dictate the selling price of the bonds. The bond selling price is always going to be based on present value. If present value is more than the face value of the bonds, then we're selling at a premium. If present value is less than the face value of the bonds, then we are selling at a discount. Last thing that we're going to do is look at how we amortize interest expense over the period of the bond when we sell at either a discount or a premium. Okay, and we're going to focus on the effective interest method. In your textbook, they teach you how to use both the straight line method and the effective interest method. Companies that have to adhere to GAAP, generally accepted accounting principles, have to use the effective interest method. So that's pretty much what all big companies use. So that's what we're going to use. Okay. And again, this actually looks similar to the amortization charts that we looked at before, but essentially we create an amortization chart, and this is very easy to set up in Excel. You can set this up in Excel using the exact formulas that they present here on the screen. Our beginning carrying amount is always going to be the present value of the bonds. That is what we issued them for. The interest expense is always going to be that carrying value times the interest rate times the period of time. The difference between interest expense and the cash paid is going to be the amortization of our discount or premium. In the event that interest expense is more than the cash paid, then the discount is going to be that difference. We're going to take, in this case, the interest expense comes to $4,807. The cash paid is only $4,500. That means we are going to amortize that discount of $307, which is going to effectively increase the carrying amount of our bonds payable. Now, let's look at what that would look like from a journal entry perspective when we make that interest payment. When we make that interest payment, we're going to debit interest expense based on that interest expense amount that we calculated on the amortization chart, that $4,807. Again, we amortize that $307 to discount on bonds payable, and the credit goes to cash, the amount that we actually paid, the $4,500. Now, we're going to use a very similar approach for the bond premium. Okay, we're going to set up our amortization table exactly the same, but what you're going to notice here, because the market interest rate is less than the stated rate, when we compute our interest expense, it is actually lower than the cash paid. The difference between those two is the amount of the premium that will be amortized. So this is actually going to reduce the carrying amount of our bonds payable. And by the time we get to the end of the term for the bonds payable, we should be back to face value. That will be true regardless of whether it's a discount or a premium. Once our discount or premium has been fully amortized, we should come back to that face value of $100,000 in this case. Okay. So similarly, our entry for the $4,500 interest payment, we debit interest expense for the amount that we computed. We credit cash the $4,500, and the difference between the two, in this case, because it's a premium rather than a discount, the premium account gets debited by the $336.